Welcome to this video on betting against beta. In this video, we will understand the premise of the betting against beta, or the BAB strategy, as well as the hypothesis behind the strategy. When stocks earn higher returns, it's usually because they're riskier. A stock with a beta of less than 1 would mean that it's less risky, and so it would earn lower returns, as compared to a stock with a beta of more than 1. Take a look at the beta of Tesla and AT&T. Based on their beta values, which stock would you prefer to buy? The answer is quite obvious. Since Tesla's beta is higher than AT&T, it would mean that it is riskier. Hence, as per CAPM, it would give better returns. So you would choose to go long on Tesla. And just like you, many other retail investors, pension fund managers, and mutual fund managers would also take the same call, based on the same logic. This collective action across the market, of going long on Tesla, increases the price of Tesla, and the stock becomes overvalued. Whereas low beta stocks are neglected, hence they tend to be undervalued. And this is the opportunity that the paper is built around. It suggests that instead of going long on high beta stocks, like Tesla, you should buy low beta stocks, like AT&T. Because that would give higher returns. And why would it give higher returns? Because high beta stocks tend to be overvalued, and low beta stocks tend to be undervalued. Now let's take a look at the paper. When we see the abstract, it might look a little complex. But if we just have a look at a few points, it's actually quite simple. Let's start reading. It says constrained investors bid up high beta assets. High beta is associated with low alpha. Alpha is nothing but excess returns. So what they're saying here is that, since investors bid up high beta assets, their returns tend to be lower. Betting against beta, or the BAB factor, which is long leveraged low beta assets, and short high beta assets, produces significant positive risk-adjusted returns. Now this is the strategy. You should go long on low beta assets and short on high beta assets. And if you're asking why? It is because this would produce better risk-adjusted returns. This hypothesis has been tested not just with stocks, but across different asset classes, like commodities, foreign exchange, as well as international equities. And if you look at each of them, you will see that as the beta goes from low to high, the returns also keep on reducing. You can see that in all the cases displayed here. To summarize, as per the BAB strategy, high beta stocks tend to be overvalued. So what should we do? We should go long on low beta stocks, and short on high beta stocks. That was all for this video.